Welcome back, everybody. Welcome to the next video in the Positive Theta Trade Management series, the YouTube series where we go over trades that result in a net positive theta in our brokerage accounts. In this video, we'll be going over earnings iron condors. If you're new to the channel, please be sure to leave a like, comment, share, subscribe, and let's jump right in and see what the earnings iron condor has to offer us. How to play earnings non-directionally. Earnings season presents us with amazing opportunities to capitalize on heightened implied volatilities on the underlyings that report them. Earnings events are also known as binary events, as there seems to be two possible outcomes that are most likely. A stock could either go up or down a significant amount following the earnings report. There is, however, a third possibility. It is trading delta neutral. While earnings events are binary in nature, when taking a look at the option pricing, we can extrapolate the expected move on a stock by taking the price of the at-the-money straddle, which is a long call and a long put, and adding and subtracting it from the current stock price. The expected move allows us to select strikes for constructing an iron condor, which is our preferred strategy for earnings. You can calculate it yourself this way, or you can take the expected move value from the website marketchameleon.com. Sometimes their calculations vary from that at-the-money straddle method, so I personally like to do both and then construct my iron condor from both of those data points. Entering the trade criteria. Like most iron condors, we look for IV rank to be greater than 35, so it is the same IV setup as traditional iron condors. Days till expiration. I like to enter these closer to expiration, between 21 and 28 days till expiration, ideally on a monthly cycle for liquidity purposes. I find that weekly cycles and monthlies beyond the first available monthly cycle doesn't carry nearly as much open interest, and the bid-ask spread is wider. Expected move, greater than 10%. Typically, I like trading earnings with greater than 10% expected moves. According to studies by Tasty Trade, they've found that trading earnings condors with 10% or more expected moves results in higher probability and profitability. This is due to the fact that the market is expecting more potential prices that the underlying can trade at post-earnings, which falls within plus or minus 10% more often than outside plus or minus 10%. Net credit. I like to look for higher credit than the traditional 33% of the width of the strikes, so on a 10-point wide condor, I like to look for 35% or higher. Depending on the expected move in credit, this can go upwards of 40 to 45%. By taking in more credit, we add more probability to our trades via increasing our max profit. In cases with 40 to 45% or more in net credit of the strikes, this can make us more flexible on the expected move criteria, and we could trade between 8 and 10% expected moves. I have some live examples coming up going into this further. Exiting the trade criteria. Profit target hit. Earnings trades are much more flexible in terms of profit taking, as IV crush is usually significant following the event. This presents us with some options that we can deploy that fits within our individual investor goals. Here are two great examples. IV crush is significant. You are in the trade overnight to 2 to 3 days. If volatility crush is significant enough following the event, I have seen these earnings trades hit 20 to 30% of max profit or greater overnight or within 2 to 3 days of opening the trade, especially with options that have less than 25 days until expiration. Option 2 is less significant IV crush and you're in the trade for 1 week or longer. We can manage the trade as a traditional iron condor and hold the trade to 35 to 45% of the max profit. Now let's move on to some live example analysis on our favorite brokerage, Tastyworks. Here we are on Tastyworks, and the first trade example that I want to go over is the Twilio earnings iron condor that I posted in the Discord yesterday. If I go over to Discord right here, you'll see that I entered this yesterday at 10:41. Twilio had earnings after market close. I sold a 360 put, bought a 350 for protection, so 10 points wide there. Sold a 430 call and bought a 440 call as protection there. I originally tried receiving a 430 credit, and I had gotten filled at 436 on my first one, and then I entered a second one, got 440, so my effective credit was actually 438. I took the value of the at the money straddle when Twilio was trading at about 392, and my downside expected move was $364, and my upside was $424. So my strikes were well beyond the expected move, and I received an amazing credit of 43.8% the width of the strikes. So this was less than our 10% expected move that we look for, but this is offset by the credit being this significant. So this trade worked out in our favor. We realized 17% of the max credit basically overnight because implied volatility had gone down from 32, and we can look at it right here. It went from 32 all the way to 5.1. So the IV rank absolutely crushed, and we made out with an overnight trade that returned 17% of the max credit. A perfect example of a trade that I could have milked for a little bit more credit, a little bit more profit, yet because it was an overnight trade, I felt that it had hit my profit targets and that I was exposing myself to a little, too much downside risk. So I decided to close it and make away with my profits. So I just wanted to pull up my chains and show my profits for this trade. So I opened up my first spread at 10:37 a.m. yesterday, opened up another one an hour later as I had an order set for 440. My average on this too was 438, and I closed out both of them for 362 this morning, realizing a nice $152 overnight. So the next trade that I'm going to go over here is a Take-Two Interactive Iron Condor. They report earnings Monday after close. I selected the August 20th expiration, selling the 160 put, buying the 150 for protection, 10 points wide. Selling the 180 call, buying the 190 call as protection, 10 points wide there as well. With a credit of $347, which is our max profit, $347, max loss of $653. IV rank at 45. The expected move is 8.2%. As I had stated in the description of this trade, the earnings is Monday after market close, and I said you can hold off and try to scalp a better entry if you like, but my limit order was hit. So I put the out there, it got filled, and let's take a look at it on the options chain. So yesterday I calculated the expected move based off of the at the money straddle, which is at 170. So Take-Two Interactive moved up about $3.50 today. So I calculated that at the time they were trading for 1440. So if we add that to 170, we get 84.40. So I set my short strike a little bit tighter, which would bring my break even to about between the two, about 183.47 to be exact. So that's my call side break even, a little bit more aggressive than the expected move. And then the put side, I selected 160, 150. If we subtract 1440 from 170, we get 156 and some change. So we're a little bit more aggressive on this Iron Condor. Let's take a look at the curve analysis. A little bit bearish deltas, but I am excited to see how the IV reacts to this earnings trade. I opened this trade when IV rank was at 45. It is currently sitting at 39.8, so we've seen some nice implied volatility crush today, but we won't see that significant drop that we see on most earning trades until after they report earnings. So we're setting ourselves up for a good probability of profit on this trade, and I can't wait to see what they do at earnings. Thank you all for tuning into this episode of Positive Theta Trade Management. Again, if you liked the video, please be sure to leave a like, comment, share, subscribe, and I'll see you guys in the next one. Happy trading.